This week, I'm giving us some updates around the investments, as well as Medicare and Social Security, so stay tuned. So we see it in the headlines almost every single day. It's almost by the hour or by the minute. A simple search of recession brought up all these different news articles talking about where we stand as an economy and in relation to the stock market. So are we headed towards a recession? Well, it's too hard to tell at this point. However, it looks like everything has been starting to slow down and it may be imminent, meaning it may start to come about here in the next couple of months. What does that mean exactly? Well, most of, if not all of the stock market has taken quite a big of a hit this year, 2022. And when you look across the board, there isn't one particular area that has done reasonably well. JP Morgan puts out a weekly market recap. In this particular one, I'm looking at the year-to-date returns for different types of indexes. For example, the S&P 500, which are the 500 of the largest stocks within the US, is showing a current year-to-date return as of October 3rd, down almost 24%. And as you scroll down or look down this particular column, it's showing you all the different returns for the different indexes, which relates to different styles of stocks and the different types of investments within those particular indexes. So equities, we'd consider stocks, right? More the aggressive part of your portfolio. Fixed income, we'd consider more the bonds. The safer, what we'd consider safer assets, although still have a risk component to them. But you see here, they're down year to date 14, 18, 10, and 14%. That's not typical, even during a recession. And that's really what's hurt a lot of our portfolios, not just our particular portfolios, but really across the board, is the idea that bonds have been getting hit relatively hard throughout the year because of the change in interest rates. So as we look across the board in terms of what do we want to invest in, what do we want to be invested in going forward? Well, not a lot of changes will come from what we have seen in the last 9 or 10 months or so. And as it relates to stocks, we don't want to get carried away by reducing the amount of stocks or equities that we have in client portfolios. We want to stay committed to our long-term strategy because we know that these things happen. There are going to be times where the portfolios can get beat up by market forces that are not within our control. And as always, we don't want to become completely fearful that we just completely go to cash and are not invested in the market at all, because we don't know the timing as to when things will come back. And when those things do come back, we don't want to be sitting in cash, missing out on and getting into that recovery just because we are fearful. So what does this mean going forward? Well, it's much of the same that we've been talking about. It's stay invested as we are, making small changes where we see fit, possibly around fixed income and bonds, reducing a lot of those positions into potentially some cash so that we don't get beat up any further, but we keep a lot of our equity and stock positions in place for when the tide turns. We are ready and prepared to get a lot of that upside potential. So again, we know there aren't too many things that we can do or we would want to do in this type of market environment, right? If we're already invested, we don't want to go about making a bunch of big changes because that can offset or that could hurt us in the long run. Meaning if we sell down a lot of assets, go directly to cash, we could potentially miss a lot of the upside, not knowing when that will take place. Because again, when we invest, we are not trying to time the market because we have no idea when markets will fall or rise. And as we've seen so much in the last couple of days, especially this particular week where the market's been really volatile, meaning really big swings up and down depending on the day, we're going to continue to see more of that in the future. And so there's no way for us to be able to time the market to get in or to get out. So we have to stay true to our long-term strategy, which is stay invested, potentially make some small changes as we see fit internally, and kind of stay status quo. As much as it hurts or it's emotionally draining to continue to see things going down, this we believe is the best course of action, as opposed to flying directly to cash or going directly into cash, sitting on the sidelines waiting. We might be missing some of that upside, which actually happened towards the latter half of the summer. We saw a big uptick and markets starting to recover in a nice way before it all deteriorated again. Now, on to some good news. Medicare recently came out and said that Part B, the premiums that you pay for on that monthly basis, are actually going to go down. So starting next year in 2023, your Part B premiums will be $164.90, assuming you are not part of the surtax, which is your income was a lot higher than some of the thresholds that Medicare has set. So that's some good news, because we had originally thought the Medicare will be increasing as well as it did for 2022 when the premiums went up to about $170. So there's a little bit of a relief on top of what looks to be something like a 10% increase in Social Security benefits. So for most of you claiming Social Security benefits, it can be an average of about $500 per month increase that you might be set to get in 2023. So that's a nice swing, and I guess a nice consolation given where things stand today, especially around the stock market. Now, keep in mind, if you haven't started taking your Social Security benefits, that increase, the CPI increase, will be accounted for in your benefits. So even though you're not taking Social Security benefits yet, those will be accounted for as part of your benefit calculation when you go to take your benefits. So don't feel like you have to run out and start Social Security right away so that you can get the increase in your benefits, because it's already going to be factored in for you going forward. So there you have it, the update for the week. To summarize, a lot going on in the investment world. However, we're staying patient. We're trying to pick and choose what we get into and what we get out of. However, we are not making major changes, even though the outlook is still looking pretty grim. Medicare seems to be coming down for next year, along with a big increase in Social Security. So be on the lookout for both of those things. And as always, if you have questions, comments, or concerns, please let us know. If you got a friend or family member who is looking for some help, especially given what's going on in the markets or just in their financial lives, feel free to introduce us to them. We're more than happy to talk with them. So I hope you have a good rest of your day and enjoy your weekend. Until next time, take care.